Hi everybody, welcome back to another episode of JB&D's Market Snips, where we're stepping out the market for some golden nuggets. Um, Today we're just gonna do some reading, see what I find. Okay, again, we're just stepping out the market for some golden nuggets. Um, let's start off with some new things that I've compiled in here. Start off with this one, chart of the week that I get from IBKR's weekly newsletter. Um, Share of wealth and share of spending. Of course, the top 20% make up for 71% of the wealth, and they make up 39% of the spending, middle class, 26% of the wealth, and 52% of the spending, and lower class obviously be lower. Last week, who performed the best? Small growth stocks, small value stocks. What does the B stand for? I'm not quite sure. Like a mix? I don't know. Okay, but obviously small caps perform better, and today small caps perform better again. Um, okay, year to date though, large growth has been the best. But second, what's the B? I don't know. Okay, third, small growth, whatever. Year to date, the worst performing real estate, consumer staples. Ah, I love consumer staples. Consumer discretionary. Last week, what did the worst? Utilities, healthcare, 40% of Russell 2000 companies have no earnings. Source here, Apollo. Okay, 40% of Russell 2000 companies have no earnings. I added the poops onto this because it's just a bunch of trash. Bunch of trash filled into this Russell 2000. It was the worst back in 2021. That's crazy. Anyways, a rising share of total wealth is held by more than 70 years. So held by people more than 70 years old. Okay, so boomers. I had these things. I wrote about these things back in March for the Estee Lauder thesis. Let me read it. Half of all U.S. wealth is held by baby boomers, and these inheritances are already being passed down. The result: women will soon control more money than ever before, and how they use this money is expected to have a profound impact. This, by the way, I got from Bank of America research. Increased wage gains coupled with the great wealth transfer position women to be key drivers of economic growth in our view. However, this isn't at the expense of men. As wealth increases, women's prosperity will help to grow the pie uh, of total affluence, expanding opportunities across the board. Women's rising wealth is also likely to change entire sectors, from specific products to how marketing is directed more broadly per global research. We address the three key sectors that we think could be disrupted: professional sports, travel, and healthcare. Also, as you can see, gender gap is increasing between young genders. Okay, healthcare. I like that. And you know how healthcare has just been beating down a lot. I want something that's big on women's healthcare, specifically because of this. Okay. Also, as you can see, gender gap is decreasing between younger generations, decreasing because more women are entering the workforce and um, rising in the ranks through the corporate jobs and all that stuff. Um, yeah, gender gap in the labor force falling. Mm, um, but yeah, so all this 30, what, 32% of total wealth in the U.S. is held by people more than 70 years old. Once that gets transferred, a lot of it's going to get transferred to women. What do women like to buy? Makeup. What does Estee Lauder sell? Makeup. They also sell skincare products, not just makeup. Um, so yeah, that's why I love that stock. Some articles. Okay, let's do that one last. That's gonna be the longest one. Let's do this one first. The commentary added here. Bearish PayPal articles are starting to hit downgrade only because of their assumption that stock price will take a while to recover, but reiterate good fundamentals, okay? They assume that the stock price is going to take longer than they had originally thought to turn around, but they reiterate good fundamentals. So I really just want you to think about that for a second, okay? They're downgrading the stock price. What's the saying? Um, Short-term voting machine, long-term weighing machine. Okay, they're downgrading in the they're downgrading stock only because in the shorts, maybe medium term, they think the stock price is just going to be down for a while. However, they're not downgrading it for fundamental reasons. Okay, let's go over the article. Famous stocks on chat, where's and more, PayPal. Ah, uh, PayPal has long-term potential. Yeah, like point out investments in buy now, pay later and AI-driven agentic commerce with the company's breakout moment might come later than expected. While we still appreciate the ingredients PayPal is cooking with, it will take time for the bread to rise, the analyst wrote. Okay, that's literally it. They appreciate the ingredients, they just think it's going to take time. Trimmed financial estimates for PayPal through 2027 lowered its price target on the stock to 70 from 85. That's what? I would downgrade a stock if fundamentals just are deteriorating. But like, just because of that, like, come on, guys. On top of that, retail sentiment seems to start shifting bearish on this stock. Literally just a few weeks ago, a month ago, so many people on Twitter were super bullish on PayPal, and I was playing calls on it maybe 2 3 months ago. I was swing some calls. I sold them for a small profit. My reason was because I saw so many people bullish on it that I just felt like no, this this doesn't seem right. Like this doesn't seem right. Um, and I was listening to a podcast the other day, 2 nights ago, and it was something like you really want to question yourself if you have full conviction on a stock, and everybody else does as well. And yeah, like that's kind of what happened here. Um, but if you have full conviction on a stock and everybody else is questioning you, then maybe you're doing something right. Um, but obviously, you really have to do your homework because there's a difference between being bullish on a good company when everybody else hates it, such as Alibaba a year ago, and being bullish on a trash penny stock that everybody's going to question you on just because they don't know about it and it's really maybe a scam company. Albemarle stock source, the reason is easy to see. What was commentary added here? Higher energy storage demand. Wrote about this in the initial due diligence. Right here it says, uh, due to higher energy storage demand and slower. Okay, let's see. If you do your homework, you'll be in the move before it happens. Let's see if I can find it. And if it's not in here, I texted it to my friend months ago. No, and here it is. Back in March, let's see. Energy and market demand remains strong. Grid grid demand surged 14% year over year. Global lithium demand. Imagine past update launches. Continues to expect double-digit annual growth in global lithium demand over the next decade. Mhm. Energy storage volume growth is expected to range from 0 to 10%. This wasn't the exact one, but let me tell you something. China EV demand will benefit all of Albemarle once the West launches. Look, I can't find the exact one. It's maybe it was in the message that I sent my friend. These data centers need or use energy storage, and lithium is used for this. Okay, simple. That's it. Let's move on. Let's move on. Okay. There's a commentary added here. Healthcare adds jobs during recessions, but is at risk of becoming recession sensitive. Could be a bad thing for the economy if these risks come to fruition. Okay, most important industries in AI is healthcare. Uh, I just kind of skimmed over it last night when I read it. Healthcare, the only major sector whose share of total U.S. employment rose in every recession and under nearly every macroeconomic condition of the past 25 years, has never posted a sustained decline, not during the 2001 economic downturn, not during the 2008-09 global financial crisis, and not during the COVID-19 pandemic. Um, Meanwhile, the much celebrated AI boom is barely visible in labor market data. Employment issues. Healthcare jobs withstand downturns. Okay, recessions are shaded. Okay, recession here, recession here. But yeah, look, healthcare's the strongest one. Healthcare didn't just avoid decline; it expanded month after month at the exact moment the rest of the economy was breaking. Okay, uh, economic stress drives up chronic illness, emergency care, and behavioral health needs, forcing hospitals and clinics to staff up precisely when other employers are cutting back. Okay, strong multipliers at the local level, support employment in transportation companies, food vendors, educational programs, general services, construction firms, and biomedical suppliers. When hospital closes, the economy immediately contracts. Okay, this locally. Um, this brings us to the real danger. Economy leading on a sector whose future stability isn't guaranteed. Three major healthcare supports are at risk. Affordable Care Act subsidies scheduled to expire at the end of the year. If they lapse, premiums for millions could jump by hundreds of dollars a month. Millions could lose coverage entirely. Rising uninsured rates increase uncompensated care burdens for hospital. Strained budgets, slow hiring, and weakened regional growth. Let's read over that again. Okay, Affordable Care Act subsidies scheduled to expire at the end of the year. If they elapse, premiums for millions could jump by hundreds of dollars a month. Millions could lose coverage entirely. Rising uninsured rates increase uncompensated care burdens for hospitals. Strained budgets, slow hiring, and weakened regional growth. In addition, Medicaid and Children's Health Insurance Program enrollment has already fallen sharply. Uh, Hospitals can absorb that level of uncompensated care without cutting services or closing outright. More than 700 rural hospitals are currently at risk of closing. And when a hospital closes, a regional economy loses one of its few recession-proof anchors. Finally, the healthcare workforce, already strained by shortages of nurses, medical assistants, mental health counselors, and clinical lab workers, faces an uncertain federal funding landscape. Trump proposed fiscal year 2026 budget includes over 400 million cuts to workforce programs to expand the supply of nurses, physicians, behavioral health specialists, and other healthcare workers. Without stable investment in training and education, these systems can't staff new units, expand services, or meet rising demand. A recession-proof sector becomes recession-sensitive. Policymakers allow Medicaid funding to erode, Affordable Care Act subsidies to expire, and the health workforce pipeline to thin. They will weaken the very sector that has kept the economy stable through every crisis of the 21st century. Low amounts of AI-driven equity exuberance, exuberance will be enough to keep the real economy from feeling the shock. I love this. I love this. Yeah, this I'll come back to it in the future if I need to. Let's see here. This has been going on for 2 years now. It's not the first time stocks move higher alongside unemployment. It's not irrational speculation. It's about higher interest rate and inflation anxiety. Again, we talked about this inflation anxiety back in the last episode a few days ago. I'm gonna have to cut this short. I have to leave soon. Um, but yeah, just okay. Leverage ETFs multiply. We looked at a similar chart to this last episode. Fundamental growth measures by economic rule. Okay, innovation. Focus is using internal funds to innovate and fuel future growth. Key fundamentals: research and development growth, capex growth, business performance, growing the business and improving margins, turning growing sales into sustainable profit. Fundamentals: sales growth, gross profit growth, and income growth. Da, 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 just read it. Just stop and read it. Okay, these are just things you want to look at, depending on the type of business you're looking to invest in or whatever. Not financial advice. Okay, speak to your financial advisor. Um, everything I share here is just opinion only. Mm-hmm. Just the dollar and the emerging market index side by side. Okay, you see when the dollar retraces, emerging markets pump, retrace, pump, retrace, pump, slower pump, but pump, retrace, pump, but not that significant. Spike, pump, dump, spike. Okay, oh, I confuse my. At some point, at some point here around here, I'm I flipped the two, but doesn't matter. You get that they're pretty much inversely correlated. Moving average of private sector hiring turns negative. This is per ADP. Again, ADP. Okay, and I got this from Interactive Brokers. Yeah. And then this we went over already. Okay, so that's what I've gone in. You know what I do need to read? I need to read Bank of America articles. I'll do that. Let me just do it on another window. Let me pull them up real quick. Give me 1 second. Okay, let's go over this quickly. All of this per the Bank of America Institute. You can find it on the website. Okay, the rise of surgical assistance. Robotic surgery is moving. Oh, okay, it's different surgical robots, advances, enhances surgical precision, optimize. Okay, they're good. Okay. Um, different segments and all that stuff. Huh. So you want to see if AI is truly good? You want to see AI help improve these surgical robots for surgeons to better utilize them during surgery. Okay. Personalized planning, automated segmentation, real-time computer vision, 5G AI remote surgery. Expects a global surgical robot market could reach 52 billion. Okay, it's growing. Nice. I don't know. So maybe I would want to look for companies that create or improve surgical robots with AI or beneficiaries of this. So companies that create or improve surgical robots with AI, or companies um, that will benefit from having these improved robots, um, or something, or I don't know. That's just a thought. I really don't know. So again, nothing's financial advice. Okay, T. Oh, renters catch a break. Number of people moving within the U.S. economy. I really have to go. Okay, people moving, falling. That's also one of the people moving to different states decline faster than those moving to states. Significant cooling and rent payment growth. So these are seeing growth. These are seeing decline. Okay. Well, that's typical, isn't it? People move to cheaper areas. Okay. Homeownership rates have declined in the past few years. Living with their parents has increased since 2022, but not compared to 2020. Cooling rent payment growth brings relief to tenants across the Sun Belt. Okay, rent, mortgage, damn mortgage, CPI inflation. So rent is back at, oh, that's nice, but still not enough. Higher vacancy rates, especially not here where I live. Higher vacancy rates in the Sun Belt give renters more justice. Well, it's good. It's some positive signs. Lower income households saw 1% year over year. Spending growth from renters has strengthened across income. Again, since I'm in such a rush, I might be skipping over some important things. Okay, let's go over the Rick report. This is from mid-November, almost a month ago. It's not time to sell the AI. Value never stopped working outside the U.S. I like that. I like that graph. Um, I'm gonna add it to my personal stuff. Or comp. Okay, let's see. This is just so I can keep track of everything. Okay. October soft sentiment measures deteriorated. State level initial claims show no job losses. Again, part-time jobs, so people can claim unemployment and start the clock, but it's not time to sell. Fifty-fifty ended nearly a decade of debt money. New tech, big investments, booming productivity, and bursting stock bubbles. Whoa. Returns of new tech indices before and after peak enthusiasm. 135%, 400%, 206%, 693%. Well, I want to check something. 1992. I just want to check if 1992 was a bottom because I've noticed some people when they do these comparisons from like past bubbles or whatever, they're the starting point to the ending point or the starting point to the peak point doesn't match with the current situation. For example, um, just to give you an example, um, I need to give you the specific, but Let me see if I can find it after I show you this chart. Um, I just want to confirm if 1992 was really a bottom. So I need to pull up the NASDAQ. And we've come a long way. Ah, it wasn't. Yeah, that's the thing. Like I don't really like these comparisons. 2008 was a bottom though. Good with that, but yeah, I don't know. Anyways, now that I'm on the chart, um, I just wanted to see some things. But anyways, sorry. Go global. 2025 on pace for best global versus U.S. returns in over 30 years. That's nice. That's good. One valuation model. International equities at a discount. U.S. at a premium. Latin America. I like Latin. Again, I like Brazil. I like China. I didn't say these things because these are good things. Global diversification improves risk-adjusted performance. One valuation model plus a 10-year expected. Mhm. International small cap remains cheap. Asia is undergoing the third most aggressive rate cut cycle. Third most aggressive rate cut cycle. A record dollar sense. Global imbalances in the US dollar to near record highs. Global economic rebalancing means lower correlations, better diversification. Okay, since the peak of globalization around 2012, 2010, correlations have been going down, especially China the most, which is great, which is amazing. That's one of the reasons why Alibaba was my biggest long-term position. It has a lower correlation to the US. It still has some correlation, but the lower the better. The world owns 26 trillion more of US assets and vice versa. I don't know, imagine if you remember last video, I was talking about the headwinds coming up for the US tech positions. Um, yeah, cut all these rates, there will be less incentive to invest in the US, and all that money is going to go elsewhere. European stocks. European stocks expected to underperform MSCI World. Huh, I don't know about that. MSCI China valuation is starting to get overextended. Really? Really? Interesting. Okay, but dollar is still low. Right. Yes, 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 yes. My Brazil proxy, I guess, or Latin America proxy is Ambev, but it's an alcohol play. Um, so it's not really an AI play. Bullish seasonality versus bearish, but okay, this is old though. More single stock alphas or big ETF. Institutional buying dips year to date. Retail dip buyers is coded. Hmm. Hmm. I want to see something. Let me think. Okay, okay. So we used to have retail selling, institutional buying. Those years were bottoms. Those years were good. Funding it up all the way up into the 2020s. Retail started buying 2015. Institutions started selling. How was that year? How was 2015 for the indices? Let me check. 2015 was it was green, but it was only 5% green on the Nasdaq, and S&P 500 was actually flat. Okay. Mm, but then these years, market's doing. I don't like this. I don't like the amount of buying increase that we've seen by retail this year alone. That's crazy. I don't like it. I don't like it. Just look at that. That's a huge candle. That's huge. I don't. Ah, yeah. I'm not. Take largest upload. Okay, this is from a month ago. So okay. See, this is a month old, so I can't really page trend though. Healthcare saw the most selling, most outlooks since 2020. Industrials for the past decade. Tech, I don't understand why. Yeah, so I can't really use this because it's. Oh, I can find it. By size and style. Broad market is. See, the flow and these ETFs. It's crazy to me. It's crazy to me. It's been easy money. It's just been easy money for these people, and at some point things have to change. They will change. Okay. Small mid cap valuations. That's small. Small cap earnings growth not positive, expected to eclipse large cap earnings growth. We went over this last video with a different chart, but always good to have different ways to look at it. Price versus EPS and the performance of small versus large caps post COVID has come and been a fundamental underperformance since late 2022. Small caps. Yeah, small cap forward PE of 16x is slightly above long term, right? This is the Russell 2000. But again, remember, 40% of the Russell 2000 right now are companies that have no fucking that have no earnings. Trash companies. They're trash companies. Small caps remain historically cheaper as large caps. Small caps are less expensive as history than any other segment across all metrics. Oh man, things we've already known for quite a long time. Smallest stocks with the Russell are lowest quality. Only 40% are expected to be profitable. You see, I'm not digging too much into this. It's focusing on the broad Russell 2000, which with a lot of crap. Weekly spending update from 3 weeks ago. Oh man, people are still spending. But trust me, or don't trust me. I personally think, my opinion, buy now pay later has a big part to play in that. The late September jobs report mixed bag, survey powering the future. Cash poor, capex rich, rate cut ready. International equities predicted to be best performing asset class in 26. Okay, that's be cautious. Be cautious. Mm, like I agree. However, if too many people see the same thing, maybe there's one flush before that happens. I don't know. And by the way, have you seen how much these international indices have rallied? Like, it's crazy. Um, so I think they should pull back. Let me show you. For example, Brazil. Oh, Brazil actually pulled back not that long ago. Um, just on Friday. Mexico hasn't really pulled back yet. hmm Um, it's probably like a pullback or something, or some consolidation, some flat movement. Show me some gas, man. Come on. Charge. It's a bunch of macro stuff. Economic concerns, labor concerns, whatever. Oh, systematic flows from 101 to reload. Potential for systematic equity buying into year end. I would say this is outdated because we actually did cut that rally that week into Thanksgiving. So skip it. Follow the flow in pole position. Credit over the past week. Short-term flows have been relentless for nearly 2 years. Mm-hmm. Mm-hmm. The thinker. Robust returns. 25 more to come. 26, 27. Okay. Chopping to 26. Okay. Thinking out loud. I am so excited about the what market? What does SA stand for? Ah, I don't know what SA stands for. South American market. I really don't know. South African market? That doesn't make sense. Oh yeah, South Africa. Right here, South Africa. Okay. Well, I'm not on the to South Africa, so and I'm not sure what the catalyst for there is. I'm not gonna go too much into this. So that's that. What else? What else? Let me check. There's a few more things. Some zero hedge articles, but um, I have to leave soon. I have to eat, and then I have to go do something. So that's gonna be it for today's episode. Thank you for watching, and I'll see you guys next time.